We saw that when the required rate of return or the required yield to maturity is exactly equal to the bond's coupon interest rate, the value of a bond is the same as its par value. We say that that bond is trading at par because in the market its price is equal to par. However, in practice, the value of the bond in the marketplace is rarely equal to its par value. This is because whenever the required return on the bond differs from the bond's coupon interest rate, the bond's value will differ from its par value. And the required rates of return are a function of the economic conditions. So as we have changing interest rates in the broader economy, the required return on a particular bond is going to change. And that's going to cause a shift in the long-term cost of debt financing. Another reason that could change, absent from overall economic condition, is the riskiness of the firm has changed. So the firm's individual risk level has changed. Anytime interest rates in the economy have increased or the risk level of the firm has increased, we'll have an increase in the required rate of return for that bond, and that will decrease the value of the bond. Likewise, if we have decreases in the overall interest rates in the economy or a decrease in firm risk, that will lower the required return and increase the value of a corporate bond. Let's go back to our bond valuation example. So we have our same basic bond that had a par value of $1,000, a coupon rate of 10%, maturity of 10 years, and a required return of 10%. And we previously calculated a bond value is exactly equal to $1,000. Now, for this bond that matures in 10 years, let's examine the effect of rate changes on a 10-year bond. Again, these rate changes could be caused either by changes in interest rates in the overall economy, which will trigger a change in the interest rate required for this particular bond. So for example, if Treasury bonds increase or decrease, then the required rate of return for our particular bond, its required yield to maturity, will increase or decrease as well. So what I've done here, what we have here is a range of different interest rates or required returns from 0% all the way to 20%. And if we have required rate of return of 10%, and keep in mind our coupon rate on this particular bond is 10%, we see that that bond has a value of $1,000. So the price of the bond is $1,000. We call that a par bond or a par value bond. But anytime that the required rate of return is less than 10%, so anytime the required rate of return is less than the coupon interest rate, we see that the bond value is more than $1,000. In fact, as we go from 9% to say 5%, we see the value of the bond increase from $1,000 when it was 10% to $1,064 when it was 9% to $1,386 when the required rate of return is 5%. So the bigger the difference between the coupon rate and the required rate of return, or the more that the required rate of return is less than the coupon rate, the more valuable a bond is. In other words, the higher price the bond is. However, if required rates of return exceed the coupon interest rate, then the value of the bond falls. So when interest rates go from 10% to 11%, the value of the bond went from $1,000 to $941. So we can see that the sensitivity then of this particular bond, we look at the price change. When interest rates went for a 1% change in interest rates from 10% to 9% caused this bond to increase in value by 6.4%. Likewise, when interest rates went from 10% to 11%, the same 1% change, but now it's a 1% increase, the value of this bond has fallen by 5.89%. So relatively small changes in required returns have a pretty big impact on this value of this 10-year bond. Now, let's take a look at a bond with a 5-year maturity. So again, we have the same coupon rate of 10%. So whether the maturity on the bond is 5 years or 10 years, if the required rate of return is 10%, which is exactly equal to the coupon interest rate in the bond, that bond is going to have a value of $1,000, and we'll say that that's a par value bond. And as we saw with the 10-year bond, as the required rate of return falls below the coupon interest rate, we see an increase in the value of the bond. However, that same 1% decrease in required returns from 10% to 9% that caused a 6% increase in the value of the 10-year bond only causes a 3.89% increase in the value of the 5-year bond. Likewise, as interest rates exceed, as required rates of return exceed the coupon interest rate, we see the value of the bond fall. And this is the same thing we saw with the 10-year bond. However, that same 1% increase in required return that caused a 5.89% decrease in the value of the 10-year bond only decreases the value of the 5-year bond by 3.7%. And let's take a look at one more bond. This bond has a 2-year maturity, and just like the 5-year bond and the 10-year bond, if the required rate of return, if the required yield to maturity is exactly equal to the coupon interest rate of the bond, 10%, the value of that bond is $1,000, the same of its par value, so we say this is a par value bond. And as before, if interest rates fall below the coupon interest rate, so if required rates of return fall below the coupon interest rate, we see the value of the bond increase. However, for the 2-year bond, a 1% decrease in the required return from 10% to 9% changes the value of the bond from $1,000 up to $1,017, or a change of 1.76%, which is less than the same effect for the 5-year bond, which was 3.89%. So a 1% decrease in required returns resulted in a 3.89% increase in the bond value for a 5-year bond and a 6.42% increase in the value for the 10-year bond. And when we look at the effects of a 1% increase in the required rate of return, we see that the value of the bond only falls by 1.71%. So we can see that the longer the maturity of the bond, the more sensitive the bond is to changes in interest rate. That's what we refer to as interest rate risk or maturity risk. Bonds with longer maturities are more sensitive to interest rate changes than are bonds with short maturities. And we call bonds that sell above $1,000, we call them premium bonds. Premium bonds are also then bonds whose yield to maturity is less than the coupon interest rate. And discount bonds are bonds that have a price less than $1,000, and bonds that have required yield to maturities or required returns greater than the coupon interest rate. We refer to those again as discount bonds. We can see the interest rate sensitivity to maturity graphically. Here we have in red the 10-year bond, in the, call it green, the 5-year bond, and in the darker blue, the 2-year bond. You'll notice, and here of course on the horizontal axis we got the required rate of return on the bond, and on the vertical axis we got the bond value, and we can see the slope of the 10-year bond is much more steep. The steeper the slope means that it's more sensitive. The price of the bond's value is more sensitive to changes in interest rate than are the 5-year and the 2-year bond. And we can see that the slope decreases as the maturity of the bonds decrease. So for a 2-year bond, a 1% change in interest rates has very minimal effect, whereas a 1% change in interest rates for a 10-year bond has even more effect. And if we were to plot a 30-year bond, it would be even steeper slope than the 10-year bond. Next, let's examine the effect of coupon rates on bond sensitivity to changes in required rates of return. So here we have a 10-year bond as before, $1,000 par value, except now the bond has a 5% coupon. And we have required rates of returns ranging from 0 to 20%. And if our required rate of return is exactly equal to the coupon rate, if it's 5%, we have a par value bond trading at $1,000. But if interest rates fall 1%, our 5% coupon bond increases to a value of $1,081, or an increase of 8.11%. Similarly, if interest rates increase, if our required yield to maturity increases from 5% to 6%, we see for that 1% increase in the required rate of return, we see a 7.36 decrease in the value of the bond. And since it's a 10-year maturity bond, we can compare this to our previous 10-year maturity bond that had a coupon rate of 10%, and we can see that the lower the coupon rate, the more sensitive a bond is to changes in the required rates of return. Let's also take a look at the time to maturity and the bond's prices. So let's look at two bonds. Again, we have 10 years of maturity. One bond, and they have a coupon. Both bonds have a 10% coupon. So the bond here that has a required rate of return of 8%, that's a premium bond because the required rate of return of 8% is less than the 10% coupon rate of the bond. So we can see with 10 years to maturity, that bond has a value of $1,134. It's a premium bond selling for more than $1,000. And then we look at our second bond that has a required rate of return of 12%, which is higher than the 10% coupon rate. So this is a discount bond. It's going to be selling for less than $1,000. So this bond, when it has a required rate of return of 12%, 10% coupon, and 10 years to maturity, it has a value of $887. But notice what happens to this bond value as maturity decreases. As we go from 10 years left to maturity to only 9 years, the value of the bond increases from $887 to $893. And then as it increases to 8 years, 7 years, 6 years, at 5 years to maturity, when the bond has only 5 years left to maturity, it has a value now of $927. And when the bond has a maturity of only 1 year, so 1 year before the bond matures, it has a value of $982, even though the coupon rate is still 10% and the required rate of return is still 10%. Excuse me, even though the required rate of return is still 12%. We see that discount bonds over their life increase in value as they get closer and closer to maturity, while premium bonds, as they get closer and closer to maturity, we see their value fall, so that at maturity they're worth exactly $1,000. We can also see graphically the effect of time to maturity on bond values. So we can have a bond, a premium bond. We'll see that over time the value it falls, so that at maturity it's worth exactly $1,000. And for our discount bonds, over time the value increases. So anytime we buy a premium bond, a bond for more than $1,000, we are getting higher interest payments. So for our premium bond in this example, the required rate of return was only 8%. What does that mean? That means everyone else in the market buying similar bonds from other companies with similar levels of risk, we're only getting paid 8%, and this bond is paying 10%. That's what makes it worth more than $1,000. So the bond is worth more than $1,000, and I'm earning, if I purchase this bond, I'm getting 10%. When everybody else in the market is getting 8%. However, that effect becomes less and less over time, so that one way of thinking about it is right before maturity, it really doesn't matter too much what interest rates are if we don't have much time to maturity. Likewise, if we purchase a discount bond, This would be a bond that, in this example, that it's paying 10%, but all other bonds in the market are paying 12%. To entice somebody to buy that, the price would have to be lower than $1,000. So even though over the life of the bond, the interest payments that you receive from purchasing this bond are less, you will get a capital gains because you purchased the bond for less than $1,000, and at maturity you will receive $1,000. So your profit or your gains on a bond are a combination of the interest payments and the capital gains. The capital gain being the difference between the purchase price and the maturity value of the bond.